Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Chief Market Strategist with Sticky Trades. And before we get into the charts, just want to be clear that everyone knows the definition of what the window is for the Santa Claus rally or the year-end rally. That actually began today. Since 1950, the S&P has risen 1.3% on average over the final 5 days of December. So that begins today and all of next week, with Monday having a market close for Christmas, gives us the other 4 days. And then the first two trading days of January, which is going to be Tuesday the 2nd and Wednesday the 3rd, will close up that window. So we've had a long stretch of rallies that do happen in this cyclical pattern. And so what happens if there is no rally? Well, that could be a sign of a bear market coming up, like we saw in 2000 and 2008. But keep in mind that in the final weeks, right before the Santa Claus rally began, we had a rally very similar to what we've seen here recently. That also occurred in 2007 before the big crash of 2008, which, by the way, led our markets down 50% in a one-year period in 2008, so I have to be very careful about that. So going to the charts, you can see that my diamonds are up on the candle charts here. I still have my downside target there at 365.10. I'm not moving that at all. That's a target like any other target you might hear from an analyst. I don't raise my targets or lower my targets most of the time. I keep them. And therefore, those who follow fundamental analysts, you'll hear them put price targets out. They'll raise them, they'll lower them on guidance, but I tend not to do that. I just keep it on the chart and we'll see. So as we get to the QQQs, you'll understand why these general targets are still in place and not canceled as well. This is target 1, 2, 3 as they follow in succession, and I do believe that we will ultimately get even far as 335.77, which is a target that I put back in November. So right now, nothing has changed on the diamonds. If we look at IWM, you could see that we have a shooting star. We have a negative divergence on the CCI, which is a result of a slightly higher high today than what we saw back on Wednesday. But we have lower highs coming in on the oscillators. That's a negative flag that I refer to, not a flag pattern per se, but a negative flag. So that downside target is 192.94. So nothing has changed. We'll be able to go through these pretty quickly. But for the Qs, I want to take a little bit of time and show you how to draw fan lines. So I have to take a step back and go to the monthly chart because there's something significant is happening right now. When drawing fan lines, you have to go back in history and pull up what the highs and the lows, and especially the lows in an uptrend, look like. So while we are way back in the past back here, we still have to draw that line out to be fan line number 1. You're basically connecting the lows and extending to the right. Now, to get fan line number 2, which is up here, you take the last touch of fan line number 1 and then start connecting that to lows and drawing that out. And then the pattern repeats over and over, where you take the last touch, draw it out, take the last touch, connect the lows, draw it out. We're now at 6 fan lines. Now, I have a rule for fan lines. When there are 3 or more fan lines, that is overbought with regard to how you look at fan lines because they're going more vertical. It's unrealistic to think that vertical moves can be sustained for any long periods of time. They can go up for months, in fact, but they cannot stay up for years. It's impossible for that to happen. There just isn't enough money in the world to keep that going in a vertical fashion. So when you have 4 or more fan lines, the likelihood of it dropping increases on the break of each fan line. But here's the rule. When you have 4 or more fan lines, let me zoom into the weekly chart so you can see this. You start to get more vertical, as I said. But now, if this breaks, there's a 90% chance it's going to go to the next fan line in the sequence. We saw this happen back here when this fan line broke way back. It dropped. We had a whole nother level of fan lines being drawn back then. But that is the case. And don't take my word on it. This is something I've been accumulating in data for over 40 years, 42 years to be exact. And so there's a 90% chance that it will go to the next fan line in the sequence, which would most likely bring it back to the 20-period moving average on the weekly. See that? So that's not a great sell-off by any stretch. It would be a respectable sell-off, but not a collapse that I would say at all. So what happens is when each fan line in the sequence starts to break, the percentage of it going to the next fan line decreases. So if we have 90% chance that that fan line breaks, it goes to the next fan line, then we'll have an 80% chance that it will drop to the next fan line in this sequence, which now you're starting to get into some significant selling should that happen. And the reason for that is there are sell stops that build up under these lines, whether it be support or trend line, moving average, doesn't matter. We saw that happen on Wednesday when the S&P dropped. Sell stops were triggered. There was no explanation from the financial media because they really didn't hit the nail on the head what really happened. But that's what happened, is that on Wednesday we triggered some sell stops and it pushed it down. So now the computers that are out there, like people or money managers that should be doing this, they're managing risk. So the higher the market goes, the tighter they move their stops. So they move these stops up and get closer and closer to where the action in the market is. So this could be a significant trigger point, and it's one that you definitely want to keep an eye on moving forward. So again, to highlight that point on my cues, that's going to be 405.86. And then we'll see the volume increase most likely as sell stops are triggered. Now, SPY, if you look right here, we have a shooting star. We have a drop in volume. We have the Y divergence on the moving average. Nothing's changed there. I told you I would put that horizontal line in place and match it to my target line back here at 450.18. I did that from last week. So that target is still in place. Nothing has changed there. The VIX showed up with a bearish engulfing candle today, but it closed over the moving average. Next week, we might see a test of that moving average, maybe even a slight breach, but I think that moving average will hold as a support level as it did back here. Remember, the moving average is not an exact floor. It's an area of support if the price is moving above it, or it's an area of resistance if the price is moving below it. So I think we'll see a little bit of a drop on the VIX, but my ultimate target here is going to be up around $18.11. Now, for you silver lovers out there, I've been reporting on silver. Remember, on Wednesday, I put out a post on X, formerly known as Twitter, and I showed everyone the reasons why I was selling out of 5% of my position. Now, I'm taking a 5-day vacation, so I did not sell another 5% today, although I probably could have with that bearish engulfing. But I do believe that silver is going to drop. When it starts to pivot, I'm going to take the money from this 5% and buy more shares than I sold at the higher level. And that's how I parlay the position. So if you want to follow me on X, just use hashtag AJSLV trades, and you can follow along with my trades. I always give the audience a chance to trade ahead of me. I never trade behind a public post like that. I'd rather give the audience and our members an advantage over my trade. So if I'm making money getting in after you, then our members and those who follow me are going to do better than me. Now, that's not any advice, and I'm not trying to twist your arm to make you go trade silver, but it's certainly a lot of fun when you use the charts, for sure. Now let's go back and look at the geopolitical news. This is thanks to Game of Trades. I tell people to follow them. They have good content on X. Just go Game of Trades, look for them, and you'll see that they put out all kinds of charts like this. Folks, this is a serious matter here because the yield curve is still inverted. Now we're measuring the 10 and 3-year yields. And so we are at the same level that we were in 1928. And notice one thing, there's no shaded area showing up here yet. See that? In the past, when the yield curve has been this inverted, we're already entering into a recession. So with that said, I believe 2024 is going to be the year of the recession. Whether they want to change the definition of recession or not, I think that's where we're headed. So that's great for consumers because prices drop. Not so great for corporations. Not so great for stock investors who are investing in those companies that are losing profits. But this is a leading indicator. It's never been wrong. Now, the probability of a recession is now elevated as a result of this. This was on the same report from the Game of Trades, by the way, and you can see that was starting to pivot lower a bit. But look at the shaded areas. Every single time this has gotten elevated here, we then pulled into a recessionary period, and then we started to drop, obviously, because we're already in the recession. So this is starting to pivot lower. Very interesting, to say the least. But this comes from Tom McClellan of the McClellan Oscillator, and this is a pretty surprising statement from Tom, being that they have never, ever seen the money supply drop like this in the modern era. And so this is quite shocking for those that are still convinced we're going back into a bull market. But you can see here the money supply is getting drained out. And this is a log scale, by the way. I don't use log scales, but this is a log scale of the S&P to show you what's happened after the drops in money supply. And see back here, coming into 2008, see how rapid the money supply dropped, and then we dropped like a rock here. And then what happened? Quantitative easing, 3, 4, 5, quantitative easing, and then it pumped the market back up. But this is a complete evaporation of M2. And that I take very seriously, and I've been talking about this for months now. This just happens to come from Tom McClellan, and I figured I'd show that out just as a reminder of what's going on here. I showed this chart to some of our members. This is showing how car owners are in the water. Basically what this means is that most of these car owners that bought new cars with high interest rates and high prices on those cars are now inverted on equity. So they have negative equity and it's rising. So think about this. If we see Americans starting to bail out on the banks and say, listen, here, take the keys from my car, I don't want it. They can't sell it without still owing the banks money. And so what happens is this drives people into bankruptcy. Now, this is a report that came out yesterday for commercial bankruptcies. This, again, shocking news that year over year, bankruptcies are up 141%, and it's still rising. So this, again, tells me the warning signs are out. We're positioned for the downside, as many of you know, and it's one of the reasons why I like to trade silver from the long side. If this thing starts melting down, then silver could be very attractive for those looking for safe havens. In fact, according to the American Association of Individual Investors, they talk about retail investors are generally wrong. They tend to get most bullish at market tops and most bearish at market bottoms. Well, what are we seeing lately? Lately, we're seeing overwhelmingly bullishness right now. And I know that because I always take the heat being more long-term bear. I always hear it from the bulls, but guess what, bulls? If you're not using the 1% rule or using any kind of risk management, you could very well be in trouble. I'm out there trying to shout from the rooftops to help people with risk management. You don't have to agree with my long-term outlook, but holy mackerel, with all the data that we're pulling up here, you should be very careful and very protective of your money, I would say. At least that makes common sense to me. So this is a leading indicator for me. I've always talked about this year over year, particularly towards the end of the year. And Philanthropy Daily tells us that the individual giving has dropped by 13.4%. For those of you who tithe, you know that most of the people who are out there tell me, they tithe 10%, which is what 10% of what their income is. So if giving is down, if charitable giving is down, then that means incomes are also down, because obviously 10% of a small number is going to result in less giving, right? That makes sense. And so this is something that you could pull up, read for yourself, and keep it on your watch list for next year as well. Towards the end of every year, I always look at this to see how this is going, and this is telling me recession again. This is the big story. Folks, now listen to me here. What I'm about to show you here with regard to the derivatives market is the most serious bit of data that I pulled up probably in all of this year. And that is really coming from the Wall Street on Parade published this article that shows how 3 Wall Street mega banks hold 157, get this, $1 trillion in derivatives. If you go back in history and look at what caused the crash of 2008, it was a mortgage debacle coupled with derivatives. And the derivatives leveraged everything on the way down, and that's when the dominoes started to go down. This 157 trillion makes 2008 look like just a simple drop in the ocean, and I'm not embellishing that. This is almost 57 trillion more than the entire world's GDP last year. So when you look at what Warren Buffett has said in the past, he calls derivatives the financial weapons of mass destruction. Folks, this is one of the reasons, just one of the reasons why I'm so bearish. I've told you this before, I'll say it again. When, not if this market crashes, but when it crashes, it's going to be shocking. And it's not going to be the fact that the market is crashing that is the shock and awe of what's happening in the financial world. It's going to be what causes the market to crash. And so don't get caught off guard. Go to stickytrades.com, look up our Sticky Trades University. You can see how I apply the 1% rule to trading. You want to make sure that you're protecting profits. You want to minimize risk and loss. And you want to also make sure that you're following the technical signals to buy with the buyers, sell with the sellers, and when the pivot points start to form, you want to know how to change your positions and switch your strategies, especially for option traders. So with that, I want to wish everyone a very Merry Christmas. I'll be talking to you next week for sure. Taking a couple of days off with the family. Hope you do too. Have a great Merry Christmas, and I'll talk to you next week. So long.